Hi everyone and welcome to the Everyman Investor. So earnings season is well underway. Many of the big companies have reported already, and in fact, many of the so-called Magnificent Seven have reported, and the price action after reporting has actually been somewhat surprising, and that's the problem when so-called mega cap stocks are priced for perfection. Additionally, the Fed has made a decision about its rates just today, and they have held the rate steady. Um, and there's various economic data that has implications for investors ahead. So let's take a look at how earnings have been going. So as I mentioned in my last video, Tesla is really in a slump. It has not delivered good earnings. In fact, in the earnings call, Elon Musk actually stated that the Chinese EV makers are going to demolish the competition. He seems to be the only owner, CEO of a carbon company that is openly admitting that his company is going to be demolished. Like in other companies' earnings, for example, Toyota, there was no mention at all of this. In fact, Toyota has got a different sort of strategy of diversifying its sort of innovation in terms of green energy versus conventional um, internal combustion vehicles, and it is going the route of hybrids, electrical vehicles, hydrogen, in terms of diversification, and has actually increased its deliveries and is still by far the most the car company that sells the most cars in the world. So for those holding on to Tesla, there are two schools of thought. One is that Tesla is now oversold and undervalued. The other school of thought is that unless Tesla stops being just a car company and goes into AI and robotics, which Elon Musk claims that it is, the stock price is going to continue dropping from here. So you might want to take a close look and listen in to the earnings call. I did not do that. I just read the news because I don't own Tesla. Now, for Netflix, on the other hand, it did really well after its earnings report. It grew its subscribers substantially, and everybody was very happy with it. The analysts were happy with it. The stockholders were happy with it. And this seems to be the only one of the seven companies in the so-called Magnificent Seven so far that has actually done well post earnings. Now, Microsoft earnings was actually pretty good. I actually sat in on the earnings call and read through the earnings report. It is growing really pretty decently, and its growth seems to be sustainable. But even so, you can see it just dipped recently after the earnings release. It is not dipping enough for me to consider buying it yet, especially at a PE ratio of 35.9. But if it drops further, then I probably will pick up more. Um, in general, anything that is sort of a superstar earnings reports with raised guidance and whatnot is probably going to lead to all these mega cap stocks faltering in terms of its price action. So that's exactly what happened to Google when it revealed that its ad data actually, ad earnings actually had some issues. Again, I didn't see into the earning call because I don't own Google, but there was quite a bit of reporting in the news, and it actually dropped quite a bit. Um, this one, on the other hand, I would say that a lot of people are saying to pick it up now, but it might be a good idea to watch for how Facebook and Amazon's earnings come out. There is some speculation that Google is losing ads to Facebook, and this could affect its potential growth in the future. So, my point is very simple: is that for those stocks, a very good example would be Nvidia. They are priced beyond perfection. Unless the company is going to be able to deliver a really stunning earnings report, you can probably expect the share price to crater a bit or a lot after the earnings release. Um, for those who are planning to buy before earnings release, in the hope that you can get a really good earnings report, that is probably a 50-50 gamble at the moment in time. As you can see from the four companies that I've gone through, only one of them, Netflix, actually did well post earnings. So, on the other hand, companies that have got very, very low expectations, for example, in Apple's case, it has dropped quite a bit on a lot of bad news consecutively over the past month or so. Um, that one is somewhat of a low bar to clear. And if it reports better than expected numbers, then it probably will do well. Um, there are other undervalued companies at the moment, but the thing is, so far for the semi companies that have reported, the main ones will be AMD and Intel. They have guided low on their first quarter earnings for 2024, and that has caused the share prices to drop as well. Um, the semi space is somewhat confused at the moment in time. Some people are talking about clearing out inventory leading to a good 2024, but at the same time, the guidance seems to be very weak for the first quarter, which is somewhat perplexing. So that's something that I'm watching closely because it could present good entry points in the near future. Now, the good news is that the Fed kept rates steady, but there's no rate cut in sight, which led to a late day sell-off of the markets in the later session. So the reason for all this is basically economic data. Now this is all very dry, but so for Q4 GDP, the actual GDP reading for the preliminary read was 3.3%, which is a lot higher than the forecast 2%, which means to say the US GDP is growing very nicely, which means to say there's no recession in sight. Now, core PCE came in light also. It came in at 2.9% versus 3% forecast, which is getting much closer to 2% than it was previously. And a lot of analysts are expecting it to hit 2% by 2025. And you'll come down nicely into the low twos by the end of this year, which can potentially lead the Fed to decide to cut its rates. So for S&P US Services PMI, the actual was 52.9 versus 51.4, which shows that the services sector in the US is still expanding. Now, this one was surprising. So manufacturing PMI actually came in at 50.3 versus sub 50s for a long time, which means that the US manufacturing is rebounding and is expanding again, which is again very good news for the economy. The problem is in employment. So for private employment numbers, the latest actual numbers was 107,000 jobs versus a forecast 150,000 jobs, which is well short of the forecast, which could mean that the labor market is actually weakening, which is both good and bad. Good in the sense that people without jobs won't spend more, which means to say inflation will come down. But at the same time, if people without jobs don't spend, then the US economy will suffer and then there will be a recession. And the good news is that the Q4 employment cost index actually was lighter at 0.9% versus a previous of 1.1%, which means to say that employment cost is also going down, which is very disinflationary, which is good for us as investors. So what do I expect based on all this data and all the earnings that have come out? I've sat through 3 or 4 earnings calls so far on stocks that I own or that I'm interested in owning. So I expect inflation to continue to cool, but at a slow rate. The last lap seems to be the hardest, and the Fed will have no motivation to cut rates, which is exactly what the Fed chair said in his press conference after the Fed meeting just today. That based on current data, the Fed is not likely to cut rates at all in March, which was what the market was hoping. Although that expectation has been coming down a lot. The Fed is expected to cut rates by May to June, but again, it depends on how inflation goes. I personally think that if inflation continues to drop, then the Fed will probably cut rates in either May or June, but the number of cuts and how much they cut is subject to quite a bit of data dependency. Now, I think unemployment is going to rise, which is probably what is going to drive inflation down. The list of companies that are cutting jobs include Microsoft, Amazon, PayPal, Meta, UBS, Merck, and a whole list. If you just read through the news on a daily basis, as I do, every company, not every company, a lot of companies that have reported their earnings are reporting that they're going to be cutting jobs. This is one of those knife edge moments whereby rising unemployment, as I mentioned, will help prevent inflation from going up, but at the same time, it can potentially cause problems with the economy. So let's hope that unemployment rises slowly and does not tip the economy into recession. Now, as I mentioned, earnings season, the forward guidance has been disappointing for many companies. AMD and Intel, for example, provided very poor earnings for guidance for Q1. I actually bought more Intel on the dip. Microsoft, I actually thought the guidance was pretty good, but everybody else thought it was not so good. So the thing is, as I mentioned, this will provide very good entry points for investors. So in Intel's case, for example, so a very prominent TV analyst actually thinks that you should stay clear of Intel because Nvidia rules the world. But the thing is, if you look at Intel's products that are coming online, and they are in production or they have just started production, the performance of Intel's chips are actually, although inferior to Nvidia's chips, the next generation chips will be almost at parity, or according to some reports, will be equal parity to Nvidia's chips. And Intel has got much more products in the pipeline. Additionally, the CHIPS Act in the US means that the US government is going to be subsidizing many of these chip companies, especially those with foundry models like Intel, that basically will be producing chips in the US or in Europe rather than in countries like China and Taiwan. China obviously being the so-called enemy, and Taiwan being the one that's at risk of being invaded. Plus, the Intel CEO just bought $120,000 worth of stock, which led me to buy at a lower entry price than him. I actually already own Intel stock. I bought it sub 35 last year. I just bought it below $43 again. But it really depends on how you read the company. In this case, all investments carry risk. I do not expect to be losing money. In fact, I'm up already from yesterday's session. The closing price was higher than my buy price. But the thing is, like I said, not everybody favors Intel. A lot of people favor Nvidia. My opinion is that Nvidia's growth is already more than baked into the stock price. And while I own Nvidia, I have no intention of adding anything into Nvidia unless there is a big disappointment in the earnings forecast and the share price corrects tremendously. Which is why I said that look for a value in stocks, and if you read through the company's products, the earnings reports, the presentations, and you monitor insider trades carefully, you might be able to pick up good stocks to buy at good entry points, especially when the market looks at what is right in front of it without looking at 3 quarters down the road or 1 to 2 years down the road. So that could provide good entry points for investors. Now, does the Goldilocks scenario continue for the soft landing without rate cuts, without massive job losses? I honestly think that this one goes down to geopolitical risk. In terms of how the war is going in Ukraine, how the Middle East conflict is going on, as well as the China-Taiwan issue. Now, China-Taiwan is one of those things that is very divisive in the sense that China is really not doing very well at the moment. Its economy is tanking. Evergrande just got declared bankrupt. And China is trying desperately to shore up its stock market by preventing short selling. On the other hand, if you study history, as it is one of my interests, you will find that many conflicts often start with dictators trying to externalize their problems. And in China's case, the easiest target would be Taiwan. The other risk would be in the US with the elections going on. Although many prominent owners and CEOs of companies have stated that no matter who's in charge, they will still boost the US economy. But the thing is, that could affect US relations with other countries, especially in Europe and NATO, which could affect European stability. And although US has the biggest economy in the world, if, for example, say Europe enters on the brink, then there might be issues for the stock market price action, and how the performance of our companies will go. So thank you for watching, and I hope to see you in my next video.